Hi, I am Ankita Pathak from Edelweiss. The Reserve Bank of India just released its first monetary policy report for FY20 with a 25 bips cut, bringing the repo rate down to 6%. In our monetary policy preview report on 2nd April, we had advocated a possibility of a rate cut. The cut was largely in line with expectations, given there was a significant pressure on the central bank to tackle low inflation and below potential growth. Let me take you to 3 key takeaways of the monetary policy report. First, RBI has maintained a neutral stance, indicating that it could move in either direction with regards to future rate cuts. However, given that inflation and growth is undershooting expectations at this point, we believe that RBI is likely to exercise more rate cuts in the upcoming policy. Secondly, both inflation and growth has been revised downwards from the previous policy. Inflation has been cut down, with upper limit for first half of FY20 being 3% and that for second half of FY20 being 3.8%. Therefore, inflation for the whole of FY20 is likely to be below RBI's target of 4%. On the growth front, the growth for FY20 has been reduced to 7.2%, with maximum for first half being 7.1% and that for second half being 7.4%. India's potential output is projected at 9%, so the output gap remains open for whole of FY20. The cut in growth has been from the weakening of investment activity and slowdown in global growth, which remains a key drag on India's exports. Thirdly, there has been significant concern of liquidity remaining in deficit despite RBI's multiple action. RBI has now allowed banks to use an additional of 2% from the SLR for their liquidity coverage ratio. Essentially, this means that banks will have an additional corpus to lend out, which is a positive move. The governor also affirmed in the press conference that RBI is working on devising multiple measures to tackle the liquidity crunch, which will help in efficient transmission of the rate cuts. The 25 basis rate cut is indicative of the fact that RBI is treading cautiously while keeping the current economic situation and any subsequent risk in mind. For a detailed analysis of the monetary policy report, you can hit the link below. Thank you.